how many, I mean, I've seen articles here in Long Island, all the towns and taxing authorities are now going back to the state for all the overtime that they incur, bringing people back from vacations and printing costs, you know, and, you know, look, we know the tax bill was signed, it was the Friday, I think it was December 22nd, that's when it was signed. You would think, to be fair, that, you know, maybe the governor would have said to people, look, if it's signed, I'm gonna do this, so people had some advance warning. And especially for the taxpayers, because I had clients that were away on vacation that couldn't pay or tried to pay from overseas, you know, prepay their real estate taxes, so it's a real problem. It would have been nice to have a heads up, that's the only thing.
So, the real estate tax portion, there was a portion of the certain village taxes that if they weren't already assessed, the village didn't have the right to collect the tax.
Correct.
So you could only pay the portion that was assessed and billed.
That's right.
You couldn't prepay the portion that was unassessed to be filed.
Correct, and that's what the governor's order did, you know, late that Friday night, and he mandated, told every taxing authority in the state, issue those, I think the technical term is warrants, so it is assessed, and yes, and so that's what I know a lot of people did. I did it as well, yeah. Yes.
So one of the rumors that I heard, I think Cuomo was talking about this, was reclassifying state taxes to be a philanthropic contribution as a workaround. Does that have any legs, or is that just a rumor that's in the works?
Well, where's Tom Walton? He's here. Tom is part of our state local tax group. So I teed him up because I knew he'd get a question. The answer is that bill has actually been passed. It's been passed, and the concept is, and Tom, jump in if I had it wrong, that there's a charitable fund set up, or a number of them in the state level, and if you make a charitable contribution, which is still deductible, the state will give you a credit, I think it's an 85% against your income taxes in the following year. And, you know, when it first came out, everyone thought it was a, you know, political ploy, smoke and mirrors, but it passed through. I've spoken to some attorneys that have informally advised the state, and they think there's a real shot that it will stand up. There's apparently a private letter ruling from a long time ago in Arizona, which had a similar thing, just, you know, just a charitable organization they set up, not as a workaround out of the federal law, but so they think that there is some merit to that. And Tom,
and Joe, there was an analogous addition to that also that enables government, counties, localities to establish their own charitable contribution resources where you could get a 95% credit on your property taxes specifically. So there's two avenues there. The question is, does it have legs? And we've debated it at the office whether the IRS would agree that it's a legitimate charitable contribution. There are rules about charitable contributions and what benefit you see from that. And it remains to be seen how the IRS will really take a position on the legitimacy of the donation.
and what is it effective?
It's phased in. The portion that you were talking about phases in January 1st of 19 at 1.5%. No, I take back. That's the employer contribution. I'll talk about that a little later. Next year.
Yes, so there is some time for the IRS to react and come out with some sort of authority saying, we don't think it works, or it does work, or something like that.
So is there anything we can do this year, or this is you know, calendar done deal? Do we do anything?
It's honestly so new that the legitimacy is for 19. Let's take a look at how it
And it's more than one state that's done it before. It's not just Arizona. There's a couple of states that did it.
I just know there's a private letter ruling for Arizona, but maybe, and all the states are all over this.
I'm saying they've done it years ago for some other reason.
It wasn't a workaround, so nobody really cared at that time.
So a quick follow-up to that. If you're going to make your contribution, does it have to be a straight contribution to this fund, or could it be done through a planned vehicle, a revised fund, charitable trust, anything that might
Great
help the
idea.
plan?
Yeah, we're a month into it.
All right, so let's see the next meeting.
Yeah.
And there's also a payroll tax component too, which has got to be thoroughly vetted too. Yes, sir.
On the way the $10,000 supplement works, so if you're a single person, you get a $10,000 limit on your Schedule A. Get married, now both of you have the same $10,000 limit, is that right?
No.
So does a married couple get
The married couple
$20,000?
splits into 5.
Yeah, it's 10. If you file a married joint return,
That's what I was saying.
10.
10.
Sorry.
So one of you in the married couple is getting shortchanged, yeah?
Correct.
Can a married couple file singly and recover the $10,000 limit?
No, it'd be split 5,000 each.
They would be filing married separate,
Right.
Yeah,
so that's where it gets split.
Yep.
So.
They have to divorce.
Something like that.
No.
They lose the alimony, but they gain the $10,000.
That's right.
Joe, you had just,
It's a small price to pay. You can't let tax planning, you know.
Take your life.
I think, Tom, you have one more?
Joe, you had just touched on the other avenue, that's the payroll tax addition to the budget. There was an employer contribution system set up, and this is what I was talking about phasing in, where the employer can pay into, say, a fund run by the state that your employee then gets to take a credit for on their personal taxes. It's a workaround of the limit on the personal taxes that you pay. It was phased in 2019 for employees making over $40,000. There's a 1.5% credit available, depending on, say, the numbers. And that phases in over 3 years, up to 5%.
Okay.
Thank you, Tom. All right, so the other side of this is the interest expense for mortgage interest. If the mortgage was in effect prior to 12/15/2017 or under a binding contract and you purchased the home by early April 2018, it's still subject to the original $1 million limitation. So the way that it worked, if your mortgage was under $1 million, the mortgage interest related to that mortgage was fully deductible on Schedule A. When that mortgage balance was over $1 million, at that point you had to do a ratio, and that ratio limited the amount of mortgage interest you could deduct. For any mortgage that's now established after that time frame, the limit is dropped from $1 million to $750,000. And the IRS hasn't come out with full details in regard to how it rolls itself out, but you should definitely speak to your accountant when it comes if you have multiple properties with mortgages on them, because then you have to do a full analysis, because you're only going to get the $1 million in total for all your mortgages that are existing, and $750,000 for anything after that. So keep that in mind. The second part of it, go back for a second, the home equity line. The home equity line historically before 2018, $100,000 worth of that, interest related to that, was deductible for regular tax. For AMT though, it wanted to make sure that you were using that home equity line to actually improve or better the home. Now that's been stepped back and it's now effect for regular tax. So when we have taxpayers that take a home equity line to go on a vacation and buy a Porsche, starting in 2018, unfortunately that interest is no longer deductible. It should be important, again, this is one of those things where you talk to your accountant. You take out a home equity line, we have taxpayers that go ahead and take out a home equity line, keep 50% of it for themselves, the other 50% to invest in their business. There's interest tracing rules that we want to look at to see if we can find a way to deduct that interest in other parts of your tax return. All right. Okay. So there's other things that have changed. Medical expenses back down to the 7.5%. They raised it up to the 10% unless you're over age 70. Charitable contributions was capped out at 50% of your AGI. That's increased to 60%. The standard deduction, this is one of those pieces where Congress came in and put it in to offset the loss of the personal exemption by doubling the standard deduction across the board. The child credit increase, that went from $1,000 to $2,000 per child. The AGI limits, they also significantly increased. Up until 2017, for married couples, $110,000, now it's $400,000. So a lot more taxpayers will be able to qualify for that child tax credit. Stock option income, there's very specific rules to it, section 83I. If you have a specific issues that we can discuss it, it's a whole long set of rules for that. Excess business losses. Excess business losses, they're limited to $500,000 per year. This is a fourth layer to worry about. Whenever your trader business was reporting losses, you had to make sure you had bases in these losses. Then you had to determine if you had at risk. Then you had to determine if it was passive or active in nature. Now this is a fourth layer that is going to carve it out to at most $500,000 per married couple, $250,000 for individuals. So it just adds another layer to determine. Now, if you have losses in these type of numbers, we have to definitely speak to your accountant because there's a netting process that has to take place. Let's see what else. Net operating losses, they've removed the provision that allows a carryback. You're allowed a 2-year carryback, they no longer allow that. You can now carry it forward indefinitely. It used to be 20 years, now it's indefinitely. Historically, for regular tax, if you had a net operating loss, you could offset it 100% against your regular tax, but AMT had a 90% carve-out. They've now instituted an 80% carve-out. So even if you have a net operating loss coming in 2018, that doesn't guarantee that you won't have to pay tax in 2018. All right. The kiddie tax, a few of us get hit with that one under income. Historically, it used to be based on the parents' rates. So depending on how the parents' income was going, we'd have to always do a comparative of the parents and the kids and see what their rates are at. That's now been changed. It actually made it more difficult now. Well, not more difficult, but now more arduous in the sense that it's now based on the estate and trust rates. At $12,000, $12,500, the max rate is hit. So now, as opposed to an individual where they were taking a while to get to the 39% and now the 37%, you're going to get to the highest tax rate much faster now in the kiddie tax rules. And in the 529 plans, yes, it does allow you to now be able to pay for elementary, secondary, and so forth. We still think it's more beneficial to make a direct contribution to directly to the school when it comes to that situation. This is the way you avoid. So if a grandparent is looking to give money to their child, money to their grandkid, if they make the payment directly to the school, it goes around the gift rule as opposed to if you make a contribution to a 529 plan where then it's considered a gift, and then those limitations are at $15,000 starting in 2018.
The 529 plan, I'm sorry, on the 529 plan, is that only in the year that it's happening going forward? Like you can't go back and take it for 17?
It's in the year that you make the contribution to the plan. Correct.
I wanted to comment, it's not just about taxes for that college contribution. Because the tax return is supposed to feed into FAFSA for your clients
Right.
who have kids going to college. And a systematic gift from a family member, a related person under the IRS code will be factored in, and you may get a tax benefit at the parents' level. You may lose it at the level of the financial aid that the college ultimately grants. So somebody has to just be very careful how that's done.
Sure. Yeah. Good point. All right, things that stay the same. We'll start with the nasty part. 3.8% net investment income tax and the 0.9% Medicare tax are still in play. That was supposed to be part of the big overhaul of the tax code. They were supposed to get rid of the shared responsibility payment, get rid of Obamacare, get rid of all these extra taxes. They're still there. So we're not escaping those. The tax rates of capital gains, thankfully, stayed at the cap rate at 20%. Those didn't go higher. The exclusion on the gain of the residence, $500,000 if married filing jointly, $250,000 for an individual. They were looking to make that requirement much larger, where it was currently you have to be it has to be principal residence for 2 out of the last 5 years. They were looking to push that to 5 out of the last 7 years, but they did not. That stayed the same. A couple basic other items. The education credits and deductions are still available, so the opportunity tax, the American Opportunity Tax Credit is still there. So is the above the line deduction if that would apply to something more favorable. And then the tip and the work opportunity tax credits are still in play. They also did the deduction for student loan interest, that is still in play as well. That caps out at $2,500, but is phased out, just like it was in 2017. All right. The alternative minimum tax, I think you pretty much went over that. I think we're good. Any other questions?
So just to be clear, the AMT remained or is gone?
It remained. That was a big push that it was going to be going away, but it remained, but they did make the levels to be in the AMT much higher. I think it's about $400,000 now is when you're going to be jumping into the AMT, when compared to your example before, you had a married couple making around $250, they were in the AMT already. So, we'll be out of that. All right, thank you, everybody. Oh, wait.
On the Obamacare item, there was something that changed about you no longer have to prove that you have insurance, right? Is there something?
The state responsibility statement, starting in 2019, that's no longer a requirement. Correct. All right, thank you.
All right, great. Thanks, Eric. Turn it over to Don.
My name is Don Brew. I'm a tax partner in the legal office of City Coupon. Let me be very quick because we have other sections to cover too. There are multiple slides in corporate section. The focus is a reduction in tax rate. So first slide explains that the tax rate went down from 35% maximum to 21% flat. And September of last year, Tax Foundation published a publication showing the effective tax rate of 200 some countries, and the U.S. was number 4 from the top, and much higher than OECD countries, G7, any country. Now at 21%, we are below OECD average, below G7 average, and on par with EU countries. So the rate is fairly low. Fiscal year companies, because the effective date is January 1st of 2018, depending on your year end, you need to allocate based on number of days, the tax you impose on the income generated throughout the year, not the portion of the year. The whole year's income is multiplied by the existing tax rate multiplied by number of days divided by 365 plus the other side of calculation. So it's a little bit confusing, but we believe the software companies will figure out how to calculate this. Okay. And next one is dividends received deduction. If a C corporation receives dividends from domestic companies, depending on your ownership percentage, you could deduct certain portion of dividends received as deduction. And before, if you have 20% or more based on the vote and value, you could deduct 80%. Now, 65%. And below 20%, 70%, now 50%. But what you need to look at is the effective tax rate. So before and after, the effective tax rate is for 20% or more, that's 7% to 7.35%. And under 20%, the tax rate, effective tax rate remained at 10.5%, so the same. And alternative minimum tax for corporations gone. But again, the calculation for fiscal year companies, because the year end is not December 31st, 2017, AMT existed until then. So you calculate your tentative minimum tax, compare that with regular tax. But the portion in 2018, the calendar year, you are not subject to AMT. So you have to do another calculation. Yes?
You talk about corporate tax.
Right.
Does that apply also to LLCs and LLPs?
LLCs, LLPs, if it is partnership, the tax is imposed on owners, so like members or partners. So this is just for C corporation. Right. And if you paid AMT, then you can have some credit being carried forward. So the use of AMT credit, I will explain it in the last section to save some time now. And NOL, because of a small glitch in the originally prescribed legislation, there are three buckets. One, the NOL existing in 2017 before actually the NOL generated in the years before the enactment. And there are two more buckets. One is NOL generated in 2018 and after. And the third bucket, actually number two, the third bucket is if you have fiscal year, the year started in 2017 and ended in 2018. So the NOL existed, you have 2-year carryback, 20-year carry forward. New NOLs started from 2018, no carryback, indefinite carry forward. In between fiscal year companies, you don't have carryback, but indefinite carry forward. But usage is limited to 80% from 2018. So the first bucket, no limitation. Second bucket, no limitation, but brand new NOL from 2018 and after, subject to 80% limitation in usage. And DPAD, this has a long history before DPAD. We had a lot of export-related incentive program, and this was one of the last one. It's gone. And 199, now it is inherited to 199A, so Andy will cover. And R&D, this is summarized provision from year 2022. So as of today, no change. But in 2022, you have new 5-year amortization rule. Right now, you can deduct and capitalize and amortize over not less than 60-month period if it is the useful life, and or within 10-year period. So there are 3 different ways of deducting the expenses, reclaiming the R&D expenditures. What makes some difference as of today is, when you calculate R&D credit, at the end of the day, you have to decide whether to reduce your deduction by the amount of your R&D credit, or you can reduce your R&D credit by the effective tax rate. So 1 minus, before we have top rate of 35%, so you could reduce your R&D credit by 35%. But right now, we have 21% flat rate. The reduction becomes 21%, not 35%. So you have a little more AMT credit if you elect under 280C. Okay? So if you are subject to these rules, I can go over each case after this presentation.
Great, thank you very much, Don. Now we'll turn it over to Andy.
Yes.
for Queen.
So Donna, if you're a fiscal filer and you have fiscal 3/31/18, there's no ability to carry back losses.
Yes, NOL from 3/31/18, no carryback. Carry forward, but
Okay.
in carry forward years, no limitation in the use.
So any company that's beyond the 12/31/17 filer loses the carryback.
That's
of
correct.
NOLs. Okay,
Yes.
great, thank you.
Great. Now we'll turn it over to Andy to talk about the pass-through activities.
Good morning, everybody. Strangely enough, tax reform really started, as Joe was saying earlier, with the Republican landmark decision to lower corporate tax rates from 35% down to 20%. Can you hear me better now?
Yes.
In fact, the Trump proposal was to lower corporate income tax rates down to 15%. Trump was in the media saying from time to time that the only thing that's not negotiable
about tax reform is the lowering of corporate tax rates. And this was, as I think Don mentioned earlier, is to really put corporate America, multinational C corporations on par with the rest of the world's businesses. But what about non-corporate taxpayers? Taxpayers like S corporations, partnerships, sole practitioners, where income taxes are paid not in the corporate context, but in the individual context. The individuals, the trust levels, at the estate levels. What about those rate reductions? So the concept of rate parity, when the legislation process was going on, was a very significant issue, as you can imagine. And in the end, Congress saw fit to enact the code section that we're going to be talking about, Section 199A, as a way of providing rate parity, lowering the tax rates for businesses that are not corporate taxpayers. So what we're going to be talking about in this segment this morning is the new pass-through deduction that can entitle a taxpayer up to 20% of their qualified business income as a deduction. We're also going to talk about the very favorable changes that come about in depreciation cost recovery, namely bonus depreciation. We'll talk a little bit about the not so favorable changes in the law with respect to interest expense and some other business provisions as well. So to get started with, let's talk about the pass-through tax deduction. This 20% pass-through deduction applies to qualified domestic trade or business income. Domestic trade or business income. As the name implies, it really only applies to earnings, income earned from U.S. sources. And we'll talk a little bit more about what that means. Qualified business income also includes gain from the sale of business assets to the extent those gains would be taxed as ordinary income, most notably known as depreciation recapture. So in selling business assets and taking a look at the overall tax cost, this will be a new aspect to kind of consider when making good business decisions. The qualified business income rules do not apply to specified service businesses. Congress, in their infinite wisdom, decided that this pass-through deduction should not apply to people who are earning compensation, wages, W-2, and service businesses, accountants, lawyers, as an example, who did not have as good a lobbying group as some others, are not going to be able to take advantage, if you're above certain income thresholds, of this deduction. How is deduction calculated? Well, there's a lot of different twists and turns and limitations, but basically, deduction starts off by taking 20% of your qualified business income, and then it's limited to the greater of 50% of wages, or 25% of wages, and 2.5% of qualified depreciable property before depreciation, meaning the gross value. So if you're in the real estate business and you don't have an awful lot in the way of wages, which is oftentimes the case, this enables you to have a different limitation to compare to in order to take the deduction. And then the deduction is further limited by 20% of taxable income adjusted for capital gains. So it's important to note that this 20% deduction is right off the top, a haircut right off the top, a deduction. So if you're in the marginal tax rate of 37%, the highest tax rate that Joe and Eric mentioned before, if you can take full advantage of the 20% deduction, your effective tax rate goes from 37% down to 29.6% as an example. Income from REITs, dividend income from REITs, and publicly traded partnerships also qualify as qualified business income, but without the wage limitations that's subject to other aspects. So they, again, had a very good lobby group. Two other things that are important to take note when looking at this deduction is, number one, as we understand it today, these calculations or these limitations apply on a business-by-business basis. And also, the wages need to be on the entity that you're doing the calculation on. So as an example, if you have a situation where you have a management company, let's say a real estate management company, performing services for 20 or 40 other LLCs that own and operate real estate, and you're looking to use the wage limitation on those entities, well, the wages are on the wrong entity. There needs to be a way to restructure or to consider these other operating LLCs as common law employers in order to take this deduction. In the interest of saving time, because I know we're running behind, we're going to cover these slides at a higher level. And to the extent that you have any questions, please stop. So as I mentioned earlier, qualified business income really relates to domestic income. So the taxpayers only get a 20% deduction on qualified business income earned inside the United States, subject to the U.S. and foreign source rules. Very complicated rules. You need someone like Jen to explain them to you. So for example, if you have a U.S. business that's earning royalties from the foreign affiliates, that's not considered, even though the cash is coming into the U.S., that's not considered domestic income for these purposes. Qualified business income also does not include income or loss from investments. So long-term capital gains and losses, dividends, other investments, and it also doesn't include interest income unless you're in the trade or business, like a bank, licensed to do business, does not include interest income as well. Qualified business income, as I mentioned earlier, does not include wages. It also doesn't include payments of reasonable compensation received from an S corporation. It doesn't include guaranteed payments from a partnership. So while qualified business income includes your allocable share of trade or business income, if you're earning part of your income as a guaranteed payment, that does not qualify for this deduction. Neither does amounts received from a partnership or acting in a capacity other as a partner. So as an example of what those two things mean, if you're in a business where signing people up for leases and doing that kind of work is part of the operating business, and you get paid a payment, that would be considered a guaranteed payment. For services, would not be considered qualified business income, and if you had an IT business performing services for that entity, that would be outside the normal realm of a partnership, and also those services would not be considered qualified business income. Disqualified specified service businesses. So Congress did an awful job of trying to define what this really means. And I put this in here, and I'll just read from it. The law disqualifies taxpayers from taking the past deduction for any trade or business involving performance services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, and brokerage services. It used to include engineering and architectural as well, but in the last minute, that lobby group was very successful, and it was pulled out. So making a determination of whether or not you're actually in a specified service business happens to be one of the more difficult things to be able to do.